Hi and welcome to part 3 of Project Evaluation Module 2 for 2070. So in the last 2 weeks we covered the basic principles of project evaluation, so that was part 1, where we look at different types of project evaluations. We look at NPV, we look at IRR, so on and so forth, and we mentioned that we use the NPV method quite a lot. It's the most commonly used project evaluation method. In part 2, we then extend the application by looking at the free cash flow analysis. So we look at how to measure the free cash flows that we use for the NPV analysis. We then also look at projects with different lives. We look at the replacement decisions and we look at the retirement decisions, right? So for this week, the question that we ask here is, how do we factor in the uncertainty of our estimates of the cash flows or the discount rates, right? So if we think about a project evaluation, we are deciding to whether to invest in a project today, right? So all the cash flows that we use in our NPV analysis, they are all expected values, right? So there's a degree of uncertainty in our estimation. So for this week, we look at some sort of robustness checks or sensitivity analysis of our base estimates. So the learning objectives for this topic is firstly to understand the sensitivity analysis and break-even analysis. We then look at the decision tree analysis to take into account the probabilities of different scenarios in the future. We then look at the role of qualitative factors in project evaluation. So the methods that we go through today are quantitative methods, but the quantitative methods have to make sense, make intuitive sense as well. So we look at the qualitative factors and we try to see if the qualitative factors are consistent with our estimates. We then look at resource constraints, either internal constraints or external constraints. So far we assume that whenever there is a positive NPV project, the firm should invest in it, right? So in this case, we have a firm with resource constraint, meaning that it only has $1 million to invest, and therefore any investment that costs more than $1 million will not be considered, even though it's a positive NPV project. Okay, so for the outline of the lecture, we first look at the quantitative methods, including the sensitivity analysis, break-even analysis, simulation. So we only touch on simulation, the concept of simulation, but we don't actually use that in the scope of this course. We then look at decision trees, and finally qualitative factors. So we mentioned before that the project's risk is measured using the required rate of return or the discount rate that we use in the NPV analysis. However, in the required rate of return, we don't take into account how correct our forecast of the cash flows is, right? So the purpose of this topic is to look at how the uncertainty in the future affects our forecast of the cash flows. So all these methods here that we consider in the course look at how uncertainty changes the accuracy of our cash flows analysis. Right. We have the sensitivity analysis, which looks at how, say if we have the best estimate and we have the worst case estimate, how would our NPV change within that range? The break-even analysis is when we look at the point of estimate where our NPV is equal to 0. For example, if our sale price, the project breaks even at the sale price level of $10, that means that our sale price should not drop below $10 for the project to be profitable. Simulation techniques are a bit more complex in that it generates a lot of data points, so that we have a robust distribution of all the possible future NPVs. decision trees is when we look at the probability, so we do a probability analysis. So if we have a few certain decisions in the future, and if we can work out the probabilities of each of the decisions, then we can work out an expected or a probability weighted NPV for the whole project. Right. So the methods are different, but the idea is the same. So we want to see how the accuracy of the cash flows affect our estimate of the NPV. So in the next few slides, I'll be walking you through the methods of each of the analysis. So we look at the sensitivity analysis first. So with the sensitivity analysis, what we do here is that we want to see the impact of one particular variable or one particular estimate on our NPV analysis. So what we want to ask here is, holding everything else constant, if I change one input at the time, then what will be the impact of that change on my NPV analysis? So what I want to do here is firstly to make a pessimistic and optimistic estimates for each variables, and if I have the probabilities of the pessimistic and optimistic estimates, then I can work out the expected estimates for each of the variables. So what I want to see here is from low to high, right? What's the range of the NPV if a certain variable varies from here to here? So for each of the variables, I would then calculate the NPV at that level of, say if I have a pessimistic estimate, I'll calculate the NPV for that particular variable when it is at the level of the pessimistic estimate. I then repeat the calculation for the optimistic case and I calculate the range. So I want to calculate the difference between my worst case scenario and my best case scenario to work out a range of the NPV. I would then repeat the calculation for all of the variables, right? So the benefits of the sensitivity analysis is that it tells us directly how the NPV would vary from our worst case scenario to our best case scenario, right? So it tells us the range of variation when our key variable changes from the best to the worst. Okay. The drawback here is every time with the sensitivity analysis, you can only change one variable at a time, so that the effect, you have to keep the other variables the same and change just only one variable. So the effect that you see on the change in NPV is only accounted for by one variable. But what happens if our all our variables are correlated, right? So for example, if sale prices and production costs are correlated, that means when sale prices increase, production costs might also increase. So if we only look at the change in sale price, we might lose the big picture, right? So we're not looking at the big picture. So with simulation analysis, it overcomes this drawback of the sensitivity analysis, in that it allows for changes in multiple variables at the same time. Right. So we're going to talk about simulation later. So as an example, let's see how we can do sensitivity analysis on a project where we want to estimate the effects of these three variables on our NPV analysis. Right. So what we have here is we have a 3-year project. The initial cash outlay is $40,000. The opportunity cost of capital, or just the cost of capital, is 10% per year. Right. So we estimate that the sale price is $70 per unit. The variable cost is $60 per unit, and the sales volume is 2,000 units. Right. So using this information, can we then calculate the NPV for the project as we normally do, right? So suppose that this is a very simple project where the free cash flows are given by the difference between our sale price and our variable costs times the volume, right, times the quantity of products. So that if our sale price is $70, our cost is $60, our profit is $10 per unit, right? So if we sell 2,000 units per year, that gives us an annual cash flow of $20,000. So applying the NPV formula, our initial cost is $40,000. Our project has 3 years of life, so we have 3 cash flows, and for each cash flow we have $20,000, right? So just using the NPV and the cost of capital is 10%, yeah. So just using the NPV formula, we can work out that the NPV is 9,737. So this is a positive number, so we accept the project, right? So step 1 is quite standard. This is what we did before in the previous 2 weeks. We now want to ask how sensitive is the result to the changes or in the variations of our estimates, right? So we have 3 estimates here. We have the sale price, we have the variable cost, and we have the volume, right? So we want to see if our estimates for these numbers change, what would the NPV be like? So let's look at sale price first, right? So we want to do sensitivity analysis for sale price. We start with the same model to estimate the free cash flows. So our free cash flow is given by our profits, sale price minus costs, times the quantity of products, right? We keep the estimate for the variable cost fixed, the estimate for the sale volume fixed. We want to change the estimate for the sale price to see how our NPV changes, right? So what we have here is, this is what we did before. This is the expected value, right, of the selling price. We also have here an estimate for the optimistic case where our sale price increases to $73, and we have the pessimistic estimate for when our sale price decreases to $63. So assuming that our calculations are correct and that our sale price can only range from 63 to 73, then this is the minimum NPV at this level of sale price, and this is the maximum NPV that we achieve at this level of sale price, right? So how do we interpret this table here? So in most of the cases, we expect that our NPV is $9,737. But when the market does extremely well, this is when our goods are in high demand, we could earn 24,000 something maximum, right? However, when the market does really badly, our NPV could drop by $25,000, so we can make a loss of $25,000, right? So what it means here is in some cases our project can generate a loss, yeah. Also, if we look at the range here, the difference between the worst case scenario and the best case scenario is nearly $50,000, right? Given that our initial cost is $40,000, this means that if our project makes a loss, we are completely wiped out, right? And also, if we compare this number with the expected case, this is the mean of the NPV. The difference here looks quite big, right? The variation here looks quite big compared to the mean. Yeah. So what we can conclude here is, therefore, our NPV analysis is very sensitive to the selling price. Right? We next look at variable costs, right? So here we do the same exercise. We fix all the other variables. We fix the sale price at the expected level, $70. We fix the estimate for the sales volume at $2,000, sorry, 2,000 units. Our cost of capital doesn't change. We want to only change the variable cost estimates, yeah? And we want to see how the NPV varies when the variable costs vary. Yeah? We do the same thing. We estimate what is the worst case scenario, so how much in maximum the variable cost can be. This is a cost, right? So the pessimistic case is when the cost increases. Yeah. And in the best case, if we can be efficient, then our cost can reduce to 55, right? So if that's the case, then our NPV would vary from 4,000 odds to 34,000 odds. Yeah. So what we see here is even when the market, even when it's in the worst case scenario for the variable cost estimate, our NPV is still positive, right? So even in this case, our project is still acceptable. At the same time, if we compare the difference in NPV between the worst case scenario for variable costs and the best case scenario for the variable costs, we can see that this difference is a bit less than what we calculated before, which was about $49,000, right? So this means that the NPV analysis is not as sensitive to our variable cost estimates compared to our selling price estimates. Yeah? So our selling price is a bit more volatile than our variable costs. Continuing on the same example, we do the same sensitivity analysis for the sales volume. So we fix the sale price, we fix the variable cost estimate, we vary the sale volume, right? So we change the sale volume. Our base case estimate, our expected number is $2,000. However, we estimate that in some case, in the worst case, the sale volume can drop to 1,900. And in the best case, the sales volume can increase to 2,300. We then calculate the NPV at each of these levels, right? At the optimistic case and at the pessimistic case. We then work out the range. So as you can see here, the range here is smaller. It's much smaller than what we saw before for the selling price estimates and the variable cost estimate. So we can conclude that the sales volume, the NPV, does not vary as much with the sales volume compared to it does with the sale price and the variable cost. Right. Also, we see that even in the worst case scenario, our NPV is still positive. Right. So to summarize, this is the results for our sensitivity analysis. So out of all the three variables, we see that the NPV is the most sensitive to selling price, and also the range of the NPV is also the highest for the selling price. Yeah. So the actions that we can take here is therefore we want to see how accurate, we want to check how accurate our estimates of the sale price is. Also bearing in mind that with the sale price estimates, in our worst case scenario, we can make a lot, right? So there's a question mark here as to whether we want to do something with the selling price, right? So in summary, in the textbook you also have one example of the sensitivity analysis, and we basically do the same thing as we did in the lecture, right? So just that in here we have a few variables, so it's a bit more comprehensive than the exercise that we went through. We have sale prices, we have variable costs, sales volume, we also have fixed costs, and also the life of the machines. Right? But all the exercises are basically the same. We have an optimistic case, we have a pessimistic case, and we want to estimate the range in between. Right? And by the way, this is a typo in the textbook. It should be the difference between the NPV in the optimistic case, so column 4, minus the pessimistic case, so column 5 here, right? So one minus the other. Okay, we then come to the next sensitivity, so robustness analysis, where we look at the break-even analysis. So with the break-even, this is what we do. We firstly measure the sensitivity of the NPV, or the profitability of a project in relation to one variable only. Right? We then calculate the level at which the NPV is equal to 0. Right? So our break-even point, for example, for the sale price, is the sale price at which our NPV is 0, meaning that our project's cash flows are just enough to cover the cost of the project. Right. So let's look at an example. This is also coming from the textbook, same example as we looked at before. So with the break-even analysis, what we want to do is firstly, we want to fix other variables, right? So we keep other variable constant. We only change one variable at a time, right? So with the break-even analysis, we want to find the level. For example, if we look at sales price, we want to find the level of sale price where the NPV is equal to 0, right? So in this table, in the first column, we have our variable names. In the second column, we have the expected value. So this is the most likely values for each of the variables below, right? In the last column, we have the break-even level. So looking at sales price, this 67 means that if the sale price is lower than 67, then our project makes a loss, right? So if the sale price falls below 67, our NPV would fall below 0, right? So comparing with the most likely case, we can be a little bit comfortable in the sense that our break-even level is less than the expected value, right? So most likely we're gonna get a positive NPV number. Okay. Similarly, if our variable costs, if the break-even level of the variable cost is 51, and because this is a cost estimate, if the variable cost is higher than the break-even level, then our NPV is equal to 0, is less than 0, right? So looking at our most likely scenario for the variable costs, sorry, this should be a positive number. So the expected variable cost is $48. This is less than 51. So most likely our project will make a profit, right? So on and so forth. Yeah. We then look at the next robustness check or sensitivity analysis. So with the third method, we have simulation analysis. So we mentioned before that with sensitivity analysis or break-even analysis, we have to fix other variables and we only allow for one variable to change, right? So the other methods are easy to understand in that our estimate gives us a direct impact of a certain variable on the NPV analysis. However, if we take into account the fact that some variables tend to vary at the same time, so if variables tend to move together at the same time, then our estimates would not be correct, right? So the question here is, how do we take into account the changes in multiple variables at one point in time? Yeah. So with simulation analysis, it involves 3 steps. Number 1, we identify the relevant variables and we specify the probability distribution of each of the variables, right? So normally for statistical tests, we rely on a notion called normal distribution, where the distribution is symmetrical and it is described using the mean value and the standard deviation value or a volatility value. Right? So most of the statistical tests are based on the normal distribution assumption, so it's important that we understand the distribution of each of the variables. We then specify the interrelationships between the variables. So we mentioned before that variables can move together, right? So sale prices and sale volume might move together, right? Or might move in the opposite direction, yeah? So sale prices increase, sales volume might decrease, yeah? So if that's the case, we have to factor in the correlation between different variables before we can simulate the NPV, right? In the final steps, we then use the computer to firstly draw random data points. We then calculate the NPV for those random values. We then simulate the exercise that we do in step A and B for many times so that we obtain a distribution for the NPV, right? So what we want to do here is, once we obtain a distribution for the NPV, we can then do statistical tests on the NPV, right? So normally with statistical tests, because we have more data points than just one data point that we use in the sensitivity analysis or break-even analysis, the estimations here that we obtain from the simulation analysis tend to be more robust, right? Tend to be more statistically correct. So as an example, this is showing us the result of step 3 from the previous slide. So I suppose that we already specify all the variables that we want. We specify the correlations between different variables, and then we draw randomly from those correlations, we draw randomly different observations, and we calculate the NPV for those observations. We repeat the exercise for many times so that we get a probability distribution like this, right? So this distribution, even though it's not perfectly normally distributed, it's still quite close to a normal distribution, right? So once we have the probability distribution, we can do all sorts of statistical tests to see, for example, how likely that our NPV will fall below 0, right? So with the simulation analysis, we mentioned before that it's more dynamic, it's more comprehensive than the sensitivity analysis or the break-even analysis. In terms of the statistical goodness of fit as well, the simulation analysis gives us more statistical confidence, right? The limitation here, however, is that the simulation analysis relies a lot on the input. For example, if we specify a wrong correlation between variables, then our NPV calculation will also be wrong, right? So the output is just as good as the input. Okay. The simulation analysis does not provide us with a definitive answer to accept or reject. What we can do is that we can only do test for confidence, right? So confidence interval testing, so on and so forth. But it doesn't tell us the direct answer to whether accept or reject a certain project. Okay. So a note here is that for simulation analysis, we discount cash flows when we calculate the NPV. We discount cash flows at the risk-free rates. Yeah. The volatility of the cash flows is reflected, however, in the distribution or in the dispersion of the distribution of the NPV. Right, so if we look at the normal distribution, this variable here, this is what we call a standard deviation. This variable here gives us the volatility of the NPV analysis. Right. Finally, we look at the decision tree analysis. So with decision tree analysis, we use the decision tree. Say if we have 3 decisions, if we can work out the probabilities of each of the decisions, then we can use the probabilities of these decisions to consider the overall or the probability weighted NPV value of all these different decisions. Right. So the decision tree analysis is used to evaluate the sequence of decisions relating to one investment project. Right. This is a probability method where we take into account the probabilities of different events occurring throughout the project. This is useful, however, it's only useful when we have a limited number of decisions to make, right? So we don't want to make our decision tree too complicated, yeah? So we want to see something like this, not something like too complicated, yeah? So if there are so many probabilities in the future, the decision tree analysis will become so complex that it become less useful. So for example, let's look at an example from the textbook. This is an example that I take from page 154 in the textbook. Right. So what we have here is we have an investment project with only 2 decisions. At the first stage, the company has to decide to whether invest in a small plant or a large plant. With a larger plant, the investment, the initial outlay is a bit higher. Right. In relation to the small plant, the managers consider that after 2 years, they might decide to either to expand the small plant or not. Yeah. So the second decision, therefore, is to expand a small plant to a bigger plant. Right. For this decision, we also have an initial outlay. Right. The company further provides us with the expected cash flows for each of these events. Yeah. We also have 2 probabilities for demand, a high demand probability and a low demand probability. Okay, so what do we have here? So if we have a large plant, if we decide to go for the large plant, and if it's in high demand, then we get $800,000 in cash flows per year, right? And so on and so forth, right? So if we have a large plant, but there is low demand, we only get $100,000 every year. If we have a small plant and it's in high demand, we generate half of the large plant's cash flows, so $400,000. For the low demand case, we get $350,000. In 2 years' time, when we expand the plant, if the demand is high, we get $500,000. However, if the demand is low, with the expanded plan, we only get $75,000. Right. So these are the cash flows related to each of the probabilities, each of the situations. Yeah. Okay. We then look at the probabilities of different scenarios. So in terms of demand, we either have a high demand or a low demand. We only have two scenarios for demand, right? So the likelihood of high demand throughout the project's life is 60%. So what we mean here is from 0 to year 10. For each year from year 1 to year 10, the demand for our product is always high, right? So if that's the case, the probability of that happening is 60%, right? Furthermore, the probability of achieving high demand for just the first 2 years and low demand for the next 8 years is 20%. The probability of getting low demand throughout the project life is 20%, right? So using this probability, we can then build a decision tree that we'll look at in the next slide, right? Okay, so using the information that we have from before, how do we build a decision tree? Yeah. So what we have here is, firstly, we have to look at what decisions that we have to make. In this case, I have two decisions to make, right? So at time 0, I have to choose to either go for a large plant or a small plant. If I decide to go for the small plant, in 2 years' time, I then have to decide to either expand the plant or not expand the plant, right? So we work out how many decisions are involved. We next have to work out the scenarios, right? So what are the scenarios involved? Okay. So for each of these plans, we're given the expectation for demand. Yeah, we only have two scenarios for demand. We could have either a high demand or a low demand. Yeah. So in terms of the demand, if we choose the large plant, this is what we have. We either have a high demand or a low demand. If we have a low demand, we expect the demand to be low for the rest of the years. If we have high demand for the first 2 years, we could then have two different probabilities from year 3 onwards. Yeah. So this is year 3 to year 10. So from year 3, our demand could continue to be high, or it could be lower, or it could be low, right? So even though we have high demand for the first 2 years, in the next 8 years from year 3 to year 10, we could still have a low demand. Okay. For our small plant, we once again start with 2 branches, either high or low. If the demand is low, it stays low for the rest of the project's life, right? If the demand for the first 2 years is high for the small plant scenario, we then are faced with a decision to either expand the project or not expand the project. But regardless of what we choose, we then have 2 scenarios for demand from year 3 to year 10 again, right? So either high or low. So using this information, we therefore can work out the possible scenarios for this case. Yeah, so 1, 2, 3, 4, 5, 6, 7, 8 scenarios. Okay. What we want to work out next is the probabilities for each of the scenarios. Yeah. So our NPV analysis here is simply just the probability weighted NPV for different scenarios. So how do we work out the probabilities? Yeah. So from the question, we know three things about probabilities. Let's look at the large plans first. So we know that the probability of high demand throughout the project, so high demand from year 1 to year 10, which is the scenario over here for the large plant, right? So the probability of this scenario is 60%. The probability of having high demand for the first 2 years and low demand for the rest of the project, so the remaining 8 years, is given by this branch in the decision tree. Right. And this is 20%. Right. The probability of having low demand is 20%, which is the difference between 100% and 60% and 20%, right? So that means that if the project has low demand at the start, it would likely to have low demand in the next 8 years as well, right? In other words, the probability, the branch over here only has one branch, right? So the probability of the project having low demand from year 3 to year 10 is 100%, right? So using these two information, we therefore can deduce that the probability of the project having low demand in the first 2 years is 20%, right? So this overall probability here is given by the probability in the first 2 years times the probability in the last 8 years, right? So if the probability of the last 8 years is 100%, the probability in the first 2 years would therefore be 20% divided by 100%, and that's 20%. Yeah. So if we can work out that the probability of having low demand in the first 2 years is 20%, we then can work out that the probability of having high demand in the first 2 years is 80%, right? Okay. We then use the same principle. So the overall probability here is the product of the probability of having high demand in the first 2 years times the probability of having high demand in the last 8 years, right? So if we can work out that this is 80%, this is 60%, then we can work out that the probability of having high demand for year 3 to year 10 is 75%, right? So this is given by 60% divided by 80%. Okay. We then do the same exercise for the small plant case, and we therefore work out the probabilities in here, right? So given that we know we build a branch, we build a decision tree, we build the branches, we work out the probabilities. We also know from the question that for each probability we have an estimate of the cash flows, right? So using this information, we therefore can calculate the probability weighted NPV for each of the different scenarios. Yeah. So once we have the decision tree, we can then look at how to use the decision tree to analyze the project's NPV. So what we want to do here in decision tree analysis is we want to use a rollback method where we evaluate the smaller decisions, so the decision that we make at a later point in time, and we work backwards, right? So we start from the smaller decision, then we work backwards to solve the big decision. Okay. So in the example that we have before, this is what we had, right? So we have a big decision here. This is when we decide to whether to choose a large plant or a small plant. Then in year 2, we have a smaller decision. This is when we decide to whether to expand the small plant or not, depending on the demand, right? So in the decision tree analysis, we want to work out the value of this decision here first using the NPV analysis. Then from here we work backwards, yeah. So once we know which branch to choose from this decision tree, we then use that to work backwards here. Okay. Okay, so let's look at the small decision first. So to recall, with the decision tree analysis, we want to work backwards, right? So we want to solve the smaller decision before we solve the bigger decision, yeah. So for this analysis on this slide, we're just looking at the branch of the tree where it's related to the expansion decision, yeah. So recalling from the previous slide, this is what we are looking at. This is year 2. This is decision 2. This is when we decide to either expand or not expand, right? If we expand, we have 2 scenarios for the demand, high and low. With the high demand scenario, we get 0.4 million per year, whereas for the low demand scenario, we get 0.075 million per year, right? And because this is starting from year 2, we only have 8 years left, right? From year 2 to year 10. Oopsie, year 10 here. So 8 cash flows, and the cash flows differ depending on the demand of the product. Right? Similarly, for the non-expansion decision, we have a high demand situation and we have a low demand situation. For the high demand, we would get 0.35 million. For low demand, we get sorry, I mixed up the number here. So with the expansion decision for the high demand, we get 0.5. For the non-expansion for high demand, we get 0.4 per year. With the low demand scenario for non-expansion, we get 0.035 million. Okay. So we want to evaluate the NPVs for these 2 different options, right? So how do we do that? So we mentioned before that the NPV for each of the options would just be the probability weighted NPV, right? So let's look at the expansion decision here. To calculate the NPV for the expansion, we calculate the NPV for the high scenario and the low scenario, and then we weigh them up, right? So when there's high demand, we get 0.5 million per year for the next 8 years. So this is an annuity. So to evaluate the high demand scenario, we just apply the present value formula and work out the value of this annuity, right? Similarly, for the low demand scenario, this is once again an annuity with an annual cash flow of 0.075, and we have 8 cash flows, right? We then have a PV. Okay. We then weigh them up using the relevant weighting factors, which is the probabilities, right? So there are 75% for high demand and 25% probability for low demand. Okay. Also, with the expansion, we have to pay an initial investment for the expansion, and therefore we deduct the initial investment out of our NPV analysis, right? The NPV number for the expansion decision is therefore around $900,000. We then do the same thing for the decision not to expand. Yeah? So with the decision not to expand, if we have high demand, we get $0.4 million per year for the next 8 years, and therefore the value of the high demand scenario is given by the present value formula, the present value of an annuity, right, with annual cash flow of 0.4. Similarly, for the low demand scenario, we work out the present value for the low demand using an annuity present value formula with annual cash flow of 0.035 million. And we have 8 cash flows once again. We then weigh them up using the probabilities of each of the scenarios. So with the non-expansion decision, our initial cash outlay is 0. We don't spend any money to expand the small plant, right? So the NPV here is about $2.1 million. So comparing the NPV of the expansion and the non-expansion case, we can see clearly that it's better not to expand the plant, right? Because the NPV here is much higher. So we mentioned before that with the decision tree analysis, what we want to do is we want to work backwards. So we start with the small decision, and then we work out the value of the overall decision once we analyze the first decision, right? The small decision, right? So in this case, we analyze the decision to either expand the small plant or not before, and we find that not expanding the plant is optimal. Therefore, if we were to choose to invest in a small plant, we would not expand it, right? So our decision tree is now collapsed to just having the small plant and not expanding it. Okay. So the choice now is very simple. We only have 2 choices, either to choose the large plant or the small plant without expansion in year 2, right? So if we look back at our decision tree, we can cross out the branches related to the expansion, right? We then evaluate each of the options based on that information. Yeah. So for the option to choose the large plant, if we look at our decision tree, this is our large plant. Yeah. We have high demand, we have low demand. High demand for the first few years, then from year 3 onwards, we then have high demand again, or low demand for the next 8 years. Right. For the low demand case, we have low demand throughout. So from year 1 to year 10, our cash flows would be the same. They will be all the same, and they will be corresponding to the cash flows for the low demand case. Right? For the high demand case, it's a bit more complicated. For year 1 and year 2, we have high demand for the first branch, for both the branches, but from year 3 to year 10, for this branch, we have high demand. But for this branch, we have low demand. Right? So our cash flows is a bit complicated here. So let's analyze the cash flows. So with the large plant, we can do the following. So from the decision tree, we can calculate the value of these cash flows first. We then can calculate the values of these cash flows. and then we can calculate the values of these cash flows, right? So there are 4 calculations that we have to do in this exercise. Okay. So with the first bit over here, we have 2 cash flows from for year 1 and year 2 for the high scenario. If there is high demand, our annual cash flow is $0.8 million, right, for the large plant. We have 2 cash flows, year 1 and year 2, and therefore the present value of these 2 cash flows is given by this formula. So this is the present value, right, not net present value. So this is the present value of the cash flows in the first 2 years for the high demand case. Yeah. We know from before that this probability is 80%. This is what we work out from the decision tree. We next look at this bit over here in our decision tree, right? And this is given by this bit over here. So this is a bit more complicated to do. Firstly, let's look at the cash flows, right? So if we have a large plant and it's high demand, then we get $0.8 million per year. We're looking at the cash flows from year 3 to year 10, and therefore we have 8 cash flows, right? But because we're looking at cash flows from year 3 to year 10, that means we're looking at cash flows at some point in time in the future, right? So the calculation that we do here is for a deferred annuity, right, where we start in year 3 instead of year 1. Okay. So the formula here gives us the present value of a deferred annuity. We then have to weight it up with the probabilities, right? So we mentioned before that, in the question, we're given that the probability of having high demand throughout, which is what we have in this case, is 60%, right? And therefore, our probability here is 60%. Yeah. We next look at our next component, which is the low demand from year 3 to year 10. So this bit over here. So similar to what we did before, this is a deferred annuity where our cash flow is only $0.1 million. This is a low demand scenario, right? We only have 8 cash flows because we're starting from year 3 and we end in year 10. We defer it by 2 years, so we have to discount it back by 2 years, right? Our probability here is 25%. Our probability here is, so this is a big bracket, right? So our overall probability here for this scenario is 0.25 times 0.8, right? That will be 20%, right? Which is what we worked out before from our decision tree. Our last cash flows, the last one that we have to calculate, is when the demand is low throughout the 10 years of the project, right? Sorry, the point have to be here. So if the demand is low for the entire project, our cash flow for each of the years would be 0.1 million. We have 10 cash flows, so it's consistently low, right? Our first cash flow is in year 1, so this is just a normal annuity. The probability of this scenario is 20%, So we times it with 20%, right? We then deduct the initial investment for the large plant, and we get the NPV for choosing the large plant. Right. With the small plant, so we established before that choosing the small plant and not expanding it is actually better than choosing the small plant and expanding it, right? So we don't have to worry about the expansion anymore. We now would just be looking at the small plant with no expansion, right? So we look at the decision tree for the small plant. If we have a small plant, we once again have high and low. If the demand is low, it will be consistently low from year 1 to year 10, right? So we'll have 10 cash flows for the low demand scenario. And there's only one scenario in here, in this branch. For the high scenario, in the first 2 years, we will have high demand. So year 1 and year 2, we have high demand cash flows, right? From year 2 onwards, we choose not to expand, so we're just looking at the lower branch of the tree here. We have 2 cases, we have high and low for not expanding, right? If we have a high demand for the not expanding case, our cash flow would be 0.4 million per year. If we have a low demand for not expanding, then our cash flow would be 0.035, right? Sorry, it's 0.35 here, 35 million here. So using this information, we once again do the same exercise as we did for the large plant, and we work out the expected NPV for the small plant, right? Small and not expanding, yeah? So what are the cash flows involved here? We only have 3 scenarios here. We have high demand in the first 2 years and high demand in the next 8 years. We then have high demand for the first 2 years and low demand for the next 8 years. Finally, we have the low demand case throughout the 10 years, right? So 3 cash flows, 3 calculations. So what we have here is, firstly, we have the high demand case for the first 2 years. This is an 80% chance, so we just times it by 80. We then have the present value of the NPV for not expanding, right? So this branch over here was already calculated from before, yeah? From when we decide to whether to expand the project or not. So now we simply have to just discount this decision back to time 0, right? So the second calculation here is simply just the discounting of the decision not to expand back to time 0. Our last cash flow is what we mentioned before. This is a low demand scenario for throughout the years, right? This is our initial cost of investing in a small plant, and therefore we can work out the NPV for choosing the small plant and not expanding it, right? So from the previous calculation, we can see that the NPV for the large plant is 0.5 million something, whereas the NPV for choosing the small plant is only 0.4 million something, right? So because the NPV for the large plant is larger, we would therefore choose the large plant. Qualitative factors. So the analysis that we looked at before look at the quantitative factors, right? So something that we can take into account and we can measure. Therefore, we can work out the variability of the cash flows based on those different quantitative factors. The qualitative factors are things that we can't measure, and therefore it doesn't come into our project analysis, our NPV analysis, right? For example, corporate image. So when firms invest in projects that could potentially destroy the environment, it might cause boycotts from the customers, it might cause scrutiny from the government, so on and so forth. So these factors could also reduce the cash flows, right, of the projects. So the important thing here is to understand that the qualitative factors are things that make intuitive sense, right? So the quantitative analysis would only be valid if it could be consistent with the qualitative analysis. Yeah. Project selection with resource constraints. So we mentioned before that for mutually exclusive projects, one of the reasons why they are mutually exclusive is simply because the firm doesn't have enough funds to choose all the positive NPV projects, right? So when the firm faces the shortage of funds, they have to prioritize which projects that give them the highest positive NPV, right? We have two types of constraints, where they have an internal constraint, meaning that if we impose a limit on how much we expend on certain projects, so I say how much we invest in a certain industry, right? So we can't really choose projects where the initial cost is higher than our limit. External capital rationing. This is when the market doesn't want to fund certain projects, right? So for example, what is the effect of cash flow constraints on project selection, right? So what we have here is we have 6 projects. We have their initial cash outlay, so this is our initial investment in year 0. We compute the net present value for each of these projects, right? So if we just ignore the initial cash outlay and we just use the NPV method to evaluate projects, we could see clearly from here that project E gives us the highest NPV, right? However, suppose that we now have a capital constraint, so we could only invest in projects where the cost is less than $300,000, right? So the maximum investment that we are willing to make is only $300,000. Okay. In this case, we exclude project E and project F, right? Because the cost is a bit too high. Okay. So our investment options are therefore limited to only these 4 projects. Okay. So our investment decision is therefore to only pick the projects that maximize our investment, our net present value, conditional on the initial outlay. Right? So in this case, our decision would be picking project D. Right? So this table shows how capital constraints affect project selection decisions. Right? These slides conclude the third part for project evaluation.